Let's talk about the income statement. The objective of this section is to read and interpret an income statement. An income statement is a summary of a firm's revenues and expenses during a specified accounting period. The income statement is sometimes called the earnings statement or the statement of income and expenses. Figure 15.7 shows a personal income statement for Marty Campbell. Although the difference between income and expenses is referred to as profit or loss for a business, it is normally referred to as cash surplus or cash deficit for an individual. It is also possible to use information from a personal income statement to construct a personal budget, a specific plan for spending your income. Figure 15.8 shows the income statement for Northeast Art Supply. For a business, revenues less cost of goods sold less operating expenses equals net income. Revenues are the dollar amounts earned by a firm from selling goods, providing services, or performing business activities. Gross sales are the total dollar amount of all goods and services sold during the accounting period. Deductions made from this amount are sales returns or merchandise returned to the firm by customers, sales allowances or price reductions offered to customers who accept slightly damaged or soiled merchandise, and sales discounts or price reductions offered to customers who pay their bills promptly. The remainder is the firm's net sales. This is the actual dollar amount received by the firm for the goods and services it has sold after adjustments for returns, allowances, and discounts. For Northeast Art, net sales are $451,000. The standard method of determining the cost of goods sold by a retailing or wholesaling firm during an accounting period is summarized as follows. Cost of goods sold equals beginning inventory plus net purchases minus ending inventory. According to Figure 15.8, Northeast Art Supply began its accounting period with a merchandise inventory of $40,000. It purchased merchandise valued at $346,000, but after deducting purchase discounts, it only paid $335,000 for this merchandise. Thus, during the year, it had total goods available for sale valued at $40,000 plus $335,000 for a total of $375,000. 12 months later, Northeast had sold all but $41,000 worth of the available goods. The cost of goods sold was therefore $375,000 less ending inventory of $41,000, totaling $334,000. A firm's gross profit is the net sales less the cost of goods sold. For Northeast Art, gross profit was $117,000. A firm's operating expenses are all business costs other than the cost of goods sold. They are generally divided into two categories, selling expenses or general expenses. Selling expenses are costs related to the firm's marketing activities. For Northeast, selling expenses totaled $37,000. General expenses are costs incurred in managing a business. For Northeast, general expenses totaled $42,500. When revenues exceed expenses, the difference is called net income. When expenses exceed revenues, the difference is called net loss. In Figure 15.8, Northeast net income from operations is computed as gross profit on sales, $117,000, less total operating expenses, $79,500. For Northeast Art, net income from operations totals $37,500. Interest expense of $2,000 is deducted from net income to obtain a net income before taxes of $35,500. The interest expense is deducted in this section of the income statement because it is not an operating expense. Rather, it is an expense that results from financing the business. Northeast's federal income taxes are $5,325. Although these taxes may or may not be payable immediately, they are an expense that must be deducted from income. This leaves Northeast with a net income after taxes of $30,175. This amount may be used to pay a dividend to stockholders, retained or reinvested by the firm, used to reduce the firm's debts, or all three.